Good morning, this is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, bringing you the morning comment for the 3rd of November. Will the BOE send optimistic signals on Super Thursday? Today marks another Super Thursday for the Bank of England as the rate decision, the meeting minutes and the quarterly inflation report are released simultaneously. Expectations are for the bank to stand pat via a unanimous 9-0 vote. We share that view due to the relatively upbeat economic data and PMI surveys. In particular, the nation's first estimate of Q3 GDP showed that growth slowed only slightly in the post-referendum era. What's more, Bank of England Governor Carney said recently that the inflationary impact of the rapid depreciation of the pound could encourage him to vote against any further monetary stimulus. He also noted that there were limits to the bank's willingness to look through the inflation rising above its target. This raises significantly the likelihood for the bank to refrain from acting, particularly because all the nation's PMI survey for October so far showed accelerated inflationary pressures. This view is also reflected by the OIS, which gives less than 1% probability for a rate reduction at this gathering. Therefore, the focus will likely shift to the Monetary Policy Committee votes and the minutes of the meeting. We expect the BOE to acknowledge that the economy has performed well lately, but to maintain a dovish tone and indicate that another cut remains on the table if things get worse. As for the inflation report, given that the economy performed better than someone would have expected following the UK vote to divorce the EU, we expect the committee's projections to remain relatively unchanged from August's report, with risk skewed to the upside. Some potential upward revisions in the forecast, combined with relatively upbeat comments from the MPC members indicating that the economy is healthy, could help GBP to gain some momentum. FOMC, see you in December. The FOMC kept its rate hike powder dry yesterday, as was widely expected, but sent some strong signals that a rate hike is imminent. The committee judged that the case for an increase in the Fed funds rate has continued to strengthen, but decided to wait for further progress towards its goals. The only other noteworthy change in the policymakers' remarks was that inflation is no longer expected to remain low in the near term due to the previous declines in energy prices. A possible rise in inflation implies further progress towards the committee's objectives, which amplifies our long-held view that the FOMC will probably move in December. Overall, this meeting simply confirmed what market participants already knew, evident by the limited reaction in USD on the news. Even though the probability for a December hike rose slightly in the aftermath of the FOMC meeting, this was not enough to ease the overall selling pressure on the greenback, which extended its recent losses during the Asia morning Thursday. In our view, this is a byproduct of the US election race becoming tighter as Trump approaches Clinton in the polls, resulting in heightened uncertainty over the actual outcome. Moving forward, we expect market focus to remain predominantly on incoming election polls. Should the poll battle remain this close or even tighten further as we approach the 8th of November, we'd expect to see similar market reactions. USD and US equities could continue to slump on increased uncertainty, while safe havens such as JPY, CHF and gold may extend their recent gains. As for the rest of today's highlights, market participants will be keeping their eyes on the UK today, as besides the BOE policy decision, we will also get the High Court's decision on whether Parliament should be allowed to vote on triggering Article 50 of the Lisbon Treaty, or if the government can trigger it unilaterally. Based on the outcome, we could see a notable impact on the pound. Should the court rule that Parliament needs to vote, GBP could surge markedly as investors speculate that lawmakers may vote against triggering Article 50. On the contrary, if the High Court's verdict is that the government can act on its own, GBP could tumble on the confirmation that Article 50 will likely be triggered in March 2017, as PM Theresa May stated. As for the UK's indicators, the nation's service PMI for October is due out, and the forecast is for a marginal decline. Even though this could otherwise hurt the pound somewhat, ahead of the BOE policy meeting, we expect this to attract less market attention than usual. In Eurozone, the unemployment rate for September is forecast to have declined. From the US, we get the ISM non-manufacturing PMI for October, and the forecast is for the index to have declined, but to remain well above the critical 50 barrier. Thus, we don't expect any such decline to affect market expectations for a potential Fed hike in December, and as such, it may not hurt the dollar too much. The nation's factory orders for September are due out as well. Besides Bank of England Governor Carney, who will present the inflation report in a press conference following the rate decision, we have no other speakers for today. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, wishing you solid trading.